You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
All right, everybody, it's time for one of my favorite solo casts of the year. We're talking about becoming better investors. We're talking about rankings, sports, tournaments, brackets, and above all, March Madness, the craziest, most exciting tournament in all of sport. But seriously, I'm being dead serious here. Even if you don't like basketball, even if you don't like sports, this podcast, I promise you, will help you to understand the stock market better and learn how to be a more efficient, top-ranked, dare I say top-seeded investor. So I know the Buckeyes didn't make it. My beloved Buckeyes did not make the tournament. It was a very sad situation this year, but that's okay. But before we get into the meat of the conversation, as always, let's get through a few housekeeping items here. If this is your first time listening or watching, thank you so much for joining us. I'm Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group in Columbus, Ohio, and you're listening to the soon-to-be renamed and rebranded Cash Podcast. While the name is still going to change, you're going to be the first to get these episodes if you subscribe. So please be sure to link up and subscribe on YouTube, Twitter, and Spotify. And if you can follow me on Twitter at Adam Koos, as well as Instagram at Adam, D as in David, Koos, you'll get all of this information first before everybody else does. So if you'd like to schedule an intro call to confidentially discuss your financial situation in more detail, or if you'd like to get a second opinion on your retirement plan and or investment portfolio, head over to our website at libertaswealth.com. Just click on that little button that says click here to get started, and somebody will reach out to you to get something on our calendar just to chat. Nothing more than that. Last but not least, all links, visuals, charts, and other educational resources are always available on our website at libertaswealth.com. So, all right, let's go ahead and get started here. I'm a big quote person. Anybody who knows me, and if you've been following us for any period of time, you know that I love, 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 love quotes. And we're in the middle of March Madness. In fact, I'm recording this on St. Patrick's Day. I'm one of these people, apparently I'm a workaholic. While everybody is probably watching basketball right now, it is officially 6:12 p.m. on Friday of March Madness, the second day of the tournament. And I'm at my office recording a podcast. So with that all being said, I'm also a huge quote person. And normally I do one quote of the day, but I'm going to do a few today because I think it's appropriate. First quote: winners are not people who do not fail, but they are people who never quit. I'm going to say that one more time. It's an unknown quote, but winners are not people who do not fail, but people who never quit. And I'm only bringing that up today because of all the things going on, which we're not going to talk about them today, but all the things going on having to do with all the bank failures going on right now around the world. I think that there's been plenty of people out there who are trying to avoid investing their money. They're trying to take a pause. They're trying to hold on to better times in the future before they invest their money. And I've said this in a few podcasts this year, I believe, but I always say the same thing, and that is most investors, because humans, it's not your fault. It's not our fault. Humans are not good investors. It's just how it is. And what I mean by that is this one lesson, there's many lessons, by the way, but this one lesson, I'll tell you right now, proves how terrible humans are at investing. So, first of all, when markets are at all-time highs, when markets are chugging along and things are going really well, people don't want to invest. Why? Because they're at all-time highs. Why would you want to invest when prices are high, right? Now, I don't mean that. That's not the advice I'm providing here. But what I'm trying to say is that's what people think. So what they say is, I'm going to wait for things to kind of calm down. The market's really high. I'm going to wait for the market to pull back. I'm going to wait for a correction. I'm going to wait for a crash. Then I'm going to invest my money because I don't want to pay high prices. Then what happens is the market goes through what it's gone through for pretty much the past 2 years, by the way. Stocks within the stock market have been going down since February of 2021. Here we are in March of 2023, and the market still has not recaptured the highs of January, February of 2021, by the way. And what do I hear people say? Well, they say things like, well, I don't want to invest now because, I want to wait for things to get better. Well, when they say they want to wait for things to get better, what does that mean? Well, we can translate that into saying they want to wait for prices to get higher before they invest. So the same people, ironically enough, who 2 years ago said they did not want to invest their money, or they did not want to put their cash to work 2 years ago when the market was at all-time highs, now say they also don't want to put their money to work because they want prices to get higher first. Wait, sorry. I didn't mean that. I didn't mean they literally say they want prices to get higher, because they would never say that. But that's what, in a sense, that's what they're saying. They want things to get better. So with that all being said, that's the quote of the day, or at least the first quote of the day. Winners are not people who do not fail, but people who never quit. So the point here is to not try to be perfect, not try to time the market, not try to pick the best time to invest, whether that be at all-time highs or at 52-week lows, but just don't quit. And if you don't feel you can do it yourself, then hire a professional who does this all day, every day. I'm a little biased, obviously, but somebody like myself, my company, Libertas, or another good, high-quality, ethical fiduciary, which you can go to napfa.org, N-A-P-F-A, NAPFA, National Association of Personal Financial Advisors, napfa.org, type in your zip code, and it'll show you all the fiduciaries within your zip code, or at least close to you, and you can interview a few people. That would be my recommendation. So anyway, I digress. Next quote of the day. This is one of my favorite quotes of all time, and I have a lot of favorite quotes, but this is one of my favorite quotes of all time. It's Michael Jordan, and this is what he said. He said, "I've missed more than 9,000 shots in my career. I've lost almost 300 games. 26 times I've been trusted to take the game-winning shot and missed. I've failed over and over and over again in my life, and that is why I succeed." And Michael Jordan's whole point is, you got to try. You got to play to win. If you don't play, you can't win. And you got to play hard. And you got to play smart. And my last quote of the day today is Bobby Knight. Bobby Knight is an ex-Buckeye. Obviously, he was the coach of the Indiana Hoosiers for a long, long time. Very controversial coach, I might add. But Bobby Knight said, the key is not the will to win. Everybody has that. It is the will to prepare to win that is important. And that is what we're going to be talking about today as we go through this whole podcast about relative strength, March Madness, tournaments, seeding, rankings. I'm going to teach you how to be a better investor, and we're going to talk about some analogies. So let's jump into it here. First and foremost, to become an excellent investor, the first thing you have to do is have to practice, just like Bobby Knight said, you have to practice proper preparation. We can call it the 3 Ps. Just made that up now. What is relative strength? I'm going to call it RS for the rest of this podcast. But relative strength is one of the best ways to build a successful portfolio. And there's not, it's not, you don't need to be a rocket scientist to understand this stuff. It's just a matter of investing in the strongest investments, and strongest. Relative strength means investing in the strongest investments on a relative basis over a certain look-back period. And what all the studies say is over the past 6 to 12 months, the best, the strongest performers over the last 6 to 12 months have a tendency to continue to perform well over the next 6 to 12 months. Furthermore, the best performers over the last 2 to 3 years have a tendency to underperform over the next 2 to 3 years. So these are the studies. So aside from all those studies, what we have to, if we step back for a second, we stop being humans, which I know is difficult to do using our emotions because money is a very emotional thing. We have to step back for a second and think, well, wouldn't it make sense to buy the best investments? Wouldn't it make sense to invest in what's strongest as opposed to buying what's weakest? I know it doesn't jive with us. When we go to the store, what we're looking for is what's on sale. We're looking for what's on clearance, right? But when it comes to investing, it doesn't work that way. What happens with investing is weakness begets weakness and growth begets growth. We want to invest in what's strongest, and we want to stay invested in what's strongest. As I always tell our clients, we want to invest in the playoff teams. We're not trying to gamble. We're not trying to invest all of our money on who we hope, because hope's not a good strategy. But we're not trying to invest all of our money in who we hope will win the Super Bowl, who we hope will win the NCAA March Madness tournament. What we want to do is we want to invest our money in the top ranked teams. I call it the playoff teams, or in the case of March Madness, we want to invest our money in the top seeded teams. And there's a lot of reasons why. We'll get into that in a minute. Tournaments of any kind are really effective methods for explaining relative strength. Football, baseball, basketball, professional sports, college sports. It doesn't matter. Honestly, March Madness, the reason I think this is one of my favorite times of the year is because it's one of the most exciting tournaments. There's always something happening literally every minute of the day between Thursday morning and Sunday night. Now, granted, things slow down a little bit, but even so, even after the first weekend, things are still very exciting. So, but my point is, it doesn't matter what sport we're talking about. It doesn't matter if it's your grandkids, soccer tournaments. It still applies here. And so when we look at March Madness specifically, because that's what we're going to be talking about today, March Madness has 68 teams that are fighting to be the champion, or in other words, to be the winner of the NCAA tournament. So to be the best in all of college sports and basketball. And so what we want to do now, when we start thinking about investments and retirement portfolio and so on, we want to imagine, what if all these teams were investments we could pick in our portfolio? In other words, when we look out into the markets, when I say markets, I say that purposely plural, not the market, the markets. What I mean by that is asset classes. That's U.S. stocks, international stocks, commodities, currencies, bonds, cash. Cash is an investment, by the way. We can break it down further from there. We can get into sectors such as utilities, materials. We can look at technology. We can go overseas and drill down from international into regions. We can drill down into countries. We can look at commodities such as gold, silver, palladium, platinum, cotton, lumber. I mean, remember COVID, how crazy lumber got? So we can break all these down into different types of sectors, subsectors, and so on. And the analogy here is that all the teams in the March Madness tournament are a lot like investing in the market. And now it's just a matter of picking the right teams. And what I mean by that is, we don't just want to invest our money equally into every team in the market, or in other words, to every sector, asset class, subsector in the market. That wouldn't make any sense. At least it wouldn't be to me anyway. It would make a whole lot more sense to focus our money on the top seeded, top ranked teams, the playoff teams, depending on the sport we're talking about. So let's dive a little deeper here. As we get deeper, when we talk about March Madness, what are the odds? Here, this is some crazy statistics, by the way. And before I get into this, I have to thank my people like Tommy Dorsey, who originated this information years and years ago. Been a friend of mine for a long time. Their research is top notch. But anyway, I digress. That's where I got all this information today that I'm going to share with you, at least most of the information. But what are the odds of picking a perfect bracket? The odds, here's the range. The odds are between 1 and 128 billion, with a B, by the way, to 1 and 9.2 quintillion. And if you want to know what a quintillion is, that's 18 zeros, by the way. So that the odds of picking a perfect March Madness bracket are extremely small. Extremely small. Now, in 1979, this goes back a long time, obviously, the NCAA started seeding the teams. In other words, ranking them. The teams were ranked from 1 to 16 in each of 4 brackets, and it made it a whole lot easier for the average Joe to pick winners, or at least to pick the top seeded or top ranked teams. And the other thing that it did is it kept the best teams from playing each other and knocking each other out of the brackets early in the process. So you see, the last thing we want to do is we don't want to have, the national championship being one of the top ranked teams versus one of the weakest teams. That would make no sense. So what we want to do is we want to give everybody, a good chance to play each other, so that you have the best teams playing each other in, call it the Elite Eight, the Final Four, and then ultimately the national championship. Now, the other thing that CD did is also made it more intuitive to pick winners. Now, not that you're not listening to this podcast to try and figure out, how to pick winners in your brackets. Obviously, that's not my point. My point is to try and draw analogies and help you become a better investor. But it did obviously make us better at picking winners of each game in the NCAA tournament, the March Madness tournament. So, for instance, picking a 16 seed, because there's 16, seeds in each bracket, to beat a 1 seed is not a very good bet. In fact, prior to 2018, because I've done articles on this subject several times in the past, by the way, and up until 2018, there had never been a 16 seed that ever beat a top ranked team in history, ever. And it wasn't until actually it was the University of Virginia, the Cavaliers. They lost to the University of Maryland, Baltimore County, or UMBC. The score was 74-54. So not only did the University of Maryland, Baltimore County beat UVA, they beat them by 20 points. They smashed them. I mean, just destroyed them. Now, what's interesting about that is, so you have this is what's called a Cinderella team. You have the first time in history in 2018 that a 16th seeded team beats a one seed, a number one ranked team ever. First time it's ever happened. The very next round, University of Maryland, Baltimore County loses to number 9 ranked Kansas State. So even in the case that a low ranked team beats a high ranked team, it doesn't last very long. In other words, the probabilities that low ranked team continues to play well and continues to win is very, very small. So gambling on these low ranked teams doesn't make any sense. And it goes back to my whole point of saying we don't want to invest our money equally in all teams. We want to focus our money on the stronger teams, those teams with a higher probability of winning. And so when we go a little bit deeper here, what does it mean when a team, or again, to follow my analogy, an investment has a higher ranking? What's that mean? Well, it means in the case of basketball, they have more talent. They have, whether it's be their starters, the people on their bench, that aren't even starting. They might have more tenured and better coaching staff than their peers. This obviously leads to better recruiting. They can continually get more and more better players throughout high schools throughout the United States, which leads to what are called legacies. So when you think of teams like UNC and Kentucky and Duke, and these teams that continually tend to have good basketball teams every single year, it's because they have this continuity in terms of good coaching, good staff, and then of course players want to come back and play for teams like Duke, for instance. I don't want to pick on them. It's not really picking on them, obviously, but when you another thing that goes into ranking is their strength of schedule. So you might have a team that has won 25 games and only lost 2 or 3 games, let's just say, but their strength of schedule, in other words, they didn't play any teams that were very high ranked. So just because they won a lot, they might have beaten a lot of teams that aren't very good. So that goes into it as well. And then the other piece of it is experience, some intangibles, experience, resilience, conditioning. There's 2 halves in college basketball. So, can people play that last 10 minutes, that last 5 minutes, really, really counts, and things get really tight, and things, the score gets close. And then this is kind of funny, as I was putting together this PowerPoint for those of you watching on YouTube, by the way, past performance is not indicative of future results. And I typed down here that this cliche of a disclosure is just as true when it comes to your retirement portfolio as it does to basketball. And what I mean by that is, just because you might have a low-ranked team beat a higher-ranked team doesn't mean you should expect it to happen a lot in the future, because we live not just in sports, but even more importantly, sports are sports, right? More importantly, our retirement portfolios, our life savings. We live in a world of probabilities, not in a world of certainties. So just because some lower ranked team or a low ranked investment or some, anomaly of an investment happens to have a great year, or a great quarter for that matter, doesn't mean we should be putting all of our money into it. And by the way, for the same reason, just because a really great investment has a bad month or a bad quarter doesn't mean we should be taking all of our money out of it either. It works both ways. It's a matter of patience, systemization, processes, discipline. I hesitate to say patience again. So anyway, past performance, whether it be with your retirement portfolio or March Madness or any type of sport, is not indicative of future results, right? That kind of goes without saying. So higher relative strength has worked exactly like the NCAA hoped it would. And what I mean by that is higher ranked teams typically advance throughout the early rounds pretty quickly. In other words, they tend to kind of knock out some of the lower ranked teams. That's by design. What this does is it leads to more exciting top ranked teams playing each other in the later rounds. So when they get to the Sweet 16, Elite 8, Final 4, what we have is the best teams playing the best. What we wouldn't want, again, as I mentioned earlier, is to have no seeding or no ranking process, and to all of a sudden have the national championship being a team beating another team 140 points to 40. It'd be terrible. I mean, well, embarrassing, I suppose, for one of the two teams, but I digress. But even more exciting, not all top seeded teams survive the early rounds that precede that coveted Final Four. But statistically speaking, these top-ranked teams win roughly 80% of the games they play. And this is where the lessons begin, by the way. And then when we look at, so we're talking about high relative strength, okay? So high relative strength means the top best ranked teams tend to win 80% of the games they play. On the other hand, the lower relative strength teams only work, whether it be in your March Madness portfolio or your real life savings portfolio, they only work if you're lucky. And ironically, I'm recording this on St. Patrick's Day. So let me give you some statistics here. The 15th and 16th seeded teams, when you go all the way back in history, have only won 9.3% of their games. And the bottom 25% of the ranked teams, so that's 13, 14, 15, and 16th seeded teams, have only won 12.8% of their games. So think about that for a second. The bottom two seeded teams in history they haven't even won 10% of their games. And the bottom quartile, they've only won 12.8, call it 13% of their games. Think about that for a second. Now here's a table, and if you're on YouTube, feel free to pause it here and really analyze this table. What we're looking at is on the left, we're looking at this top, basically the seeded teams from 1 to 16. And we're looking at every round, first round, second round, regional semifinals, regional finals, the national semis, and the national title, of course, the championship game. And we're looking at how many games have been played, how many games have been won based on the number of, based on the seeded team in question. And on the far right, you can see the percentage or the winning percentage of each of these seeds. So right off the top, you can see when you look at the 16th seeded teams, 0.67% is their winning percentage. When you look at the 1 seeded teams, 80%. And so in the March Madness bracket, there's four regions. So you have 4 1 seeds. In other words, you have 4 top ranked teams. You also have 4 2 seeds, 4 3 seeds, 4 4 seeds, and so on. And my analogy that I'm trying to draw here is to say that what we want to do with our investment portfolios is we want to invest our money on those top 2, 3, and 4 seeds, whether that be 16 investments, maybe 20, 24, something along those lines. And we want to avoid the bottom seeds, because while it might be really exciting when one of those unlikely players or unlikely teams come around and win, they call them bracket busters, it's exciting, but it doesn't happen very often. It's not exactly the best retirement strategy in the world. So if I move on here, here's some crazy statistics. I'm going to boil this down pretty simply for you here. I titled this More Maddening Statistics, but number 1 seeded teams have won the greatest percentage games at 80%, like I just mentioned a second ago. The top 3 ranked teams have combined winning percentage. So when you look at all the top 3 ranked teams in history, they have a combined winning percentage of just over 73%. So if you bet on the top 3 seeded teams, you have a 73% chance of winning, just using history as a guide. If we go the opposite direction, the bottom 3 ranked teams have a combined winning percentage of, wait for it, 8%. For those of you listening on Spotify, iTunes, I apologize. You don't get the bullet points here on YouTube. That everybody has the punchline already right in front of them here. Bottom three ranked teams have a combined winning percentage of only 8%. And by the way, what that breaks down to is they've only won 39 times out of 444 games. Why in the world would you want to invest in investments, or in other words, teams that have this type of probability of success? You wouldn't, obviously. The top 5 seeded teams have produced a winning percentage of 68%, which is still really good, by the way. That's more than 2/3. While the bottom 5 teams, the bottom 5 ranked teams, have only won 17% of their games. The top 3 ranked teams, and I'm gonna say this twice, by the way, just to make sure this sinks in. The top 3 ranked teams have won 495 games. Okay? The bottom 3 ranked teams have only played in 483 games. I'm going to say that one more time. The top 3 ranked teams have won 495 games. The bottom 3 ranked teams have only played in 483 games. The bottom 3 ranked teams have not played in as many games that the top 3 ranked teams have won. And I don't know what else to say. So the top 3 seeded teams have won the national championship in 33 of the 37 years it has existed. And again, I want to say one more time, just because I think it's important to repeat, that we're not trying to invest our money, metaphorically speaking, in the top investment here. We're trying to invest our money in the top 3 or 4 seeds across, in this case, using this analogy, 4 different brackets, which equates to anywhere between 12, 16, 20 plus investments. We want to stay invested in strength, because strength begets strength, growth begets growth. All right, bracket busters, Cinderella teams. Bracket busters, Cinderella teams, this is when a low-seeded team defies all the odds and takes out a high seed. It happens. It happened. I mean, I've got my bracket for this year, and Arizona got beat already very early, which took out 3 rounds for me. My bracket's not busted completely, but it's not looking too good as a result. But I imagine that probably happened to a lot of people, however. 2 and 3 seed, or in other words, 2 and 3 ranked teams win more than 2/3 of their games, while the bottom seeds only win 1/3. Still, investors, when we think investors, we think investors in the market, retirement portfolios. They spend as much time in March Madness brackets evaluating which 11, 12, or 13 seed will win their first game as they do analyzing which top seed is likely to win the whole tournament. So what we're talking about here is just wasting time. Again, the 2 and 3 seeds win more than 2/3 of their games, while the 11 seeds only win 1/3 of their games. So why are we wasting our time here? And I would argue that we shouldn't be wasting our time. But Benjamin King, he did some studies having to do with investing risk, and he said that 80% of the risk of a stock is associated with the sector the stock is in and the overall market. So in other words, if the trend of a market is going up, if the trend of the sector of that stock is going up, then 80% of the risk of that stock is associated with that sector risk or the market overall, whereas only 20% of the risk is associated with the stock itself. So what that means is when the overall market is struggling, it's kind of hard to pick winners, because it's almost like when we think of the weather. If the weather is bad, if it's pouring, it's just going to be hard to have a good day. But if the weather is sunny and shining, it makes life a whole lot easier to pick, to have a good day. Well, in the market, if the market is doing really well, then now we can pick top-ranked stocks and we can have a really good day, a really good year, a really good decade for that matter. But if the market is having a really poor time, if it's in the middle of a bear market like we've been living in this past couple of years, it becomes very difficult to find the best investments. And even then, we might just own the cleanest dirty laundry. And what I mean by that is, just because we own the best investment doesn't mean that even though it's outperforming on a relative basis, that doesn't mean it's still going down on an absolute basis, right? So that's what relative strength is all about. Now, do you think, for those of you out here who are gamblers, by the way, do you think you're a bracketologist? Do you think that you've got it all figured out? Do you think you're a deep value investor? Do you think that buying strength, buying winners is a bad idea? Do you think that, buying the dogs of the Dow, buying the cheapest stocks are the best way to go? Here's some statistics, and this relates directly to the market. 15th seeded teams, in other words, teams in March Madness that are ranked 15th, with 16 being the worst, obviously. 15 seeded teams have only won 9 games out of the 140 they've played. And you may be so good at what you do in your research that you may be the person that just happens to predict that next win by a 15-seeded team. But keep this in mind. You're also predicting the elimination, because if that 15th seed wins, they're playing a 2 seed. So you're also predicting the elimination of a high relative strength 2 seed or second ranked team, or in other words, teams that have won 94% of their first round games and 71% of all their NCAA tournament games ever played. So even if you think you're good at picking those, call it Cinderella winners, the underdogs, you're also trying to predict, you're betting against teams that have a high probability of winning. 94% their first game, 71% overall. That's pretty tough to do. Now, again, picking deep value teams might seem alluring. It might seem exciting. It might seem, really sexy. But at the end of the day, 15 seed teams have only been correct 6% of the time. That's it. So the question then comes to, when we think about our portfolios, our retirement portfolios, what side would you rather be on? Would you rather be on the side where you're trying to bet on the teams or the investments that have just gone down in value, hoping they come back? Or would you rather just invest in the investments that have exhibited strength in relatively recent history? Because again, strength begets strength, growth begets growth. Now, if we bring this all together here, when we rank or seed investments, we're using the same type of process, at our office, other people that use technical analysis, that the NCAA does when it comes to ranking success versus their peers. The difference is, instead of basketball teams, or in the case of football, football teams, what have you, we're just looking at investments. We're looking at what's the best asset class: U.S. stocks, international stocks, fixed income, commodities, currencies, cash. There's 6 asset classes. Then when we look at the top asset classes, let's just say we pick the top 2. Now we're going to break it down and say, what are the top sectors? What are the top regions? What are the top countries? What are the top stocks? And what we end up having at the end of the day is, what are the best stocks within the best sectors, within the best industry groups, within the best asset classes in the market, and let's just stay with those. And when any one of them starts to get weak, because over time things do get weak, what we want to do is we want to eject those weakening positions or laggards, and we want to replace them with whatever's at the top that we don't already own. And that's what we call sector rotation. That's just a really nerdy phrase, but all it means is staying with strength or staying invested with the winners. And this analogy, by the way, works in any sport. It doesn't matter if it's college football. We're talking about March Madness right now, obviously, but it works with the NFL, NBA, Major League Baseball, college wrestling, the UFC, or like I mentioned earlier, your grandkids' soccer tournament. They're going to put the best teams at either end of the bracket. The worst teams are going to play the best teams, and your champion's going to be one of the best teams. That's how it works. Where would you put your money? Now, would you invest your money in a lower ranked team just because your grandchild's on it? Just because it's your darling stock? Or are you going to invest your money in the best team? That might have been somewhat of a controversial statement, I suppose. But if I bring this full circle again, I keep saying growth begets growth, strength begets strength. Again, all the relative strength studies say that the investments that have outperformed in the last 6 to 12 months have a tendency to continue outperforming over the next 6 to 12 months. The 2 to 3 year studies say the opposite. Investments that have a tendency to have outperformed over the last 2 to 3 years have a tendency to underperform over the next 2 to 3 years. So I'll throw in here now, and this is huge, by the way. This is key information called cheat code here, secrets. When you look at star rankings for investments, and I'm not going to pick a company because I'll get in trouble, but when you look at star rankings and you're looking at 5-year annualized performance, what did I just get done saying? if you look at investments that's a 5-star or a 4-star investment over the last 5 years, chances are you're just looking at historical performance, and chances are it's probably not going to do all that well going forward, because we're not looking at the right we're not looking at the right information. We have to look at the right information. We have to look at what makes sense. All right, to close out today, if you don't, and this goes back to the quotes, by the way, if you don't play, you don't get paid. I mean, that's what the whole point here is. If you don't fill out your bracket, you're automatically losing. If you're sitting on the sidelines, and I'm not, I know of investors, they're not clients of ours, but I know of investors that got out of the market. This is a true story, that got out of the market in 2009, and they got in for a very short period of time a couple years ago, but they got out again, and they've never been back in the market again, ever. And they're so terrified because the market, again, the money's an emotional thing. So they're so terrified to get back in, they would just rather sit back and watch and wait for the best time to invest, when it's impossible to pick the best time to invest. You can't do it. I've been doing this for 21 plus years as a professional, as a chartered market technician, as a technical analyst. And I can tell you with personal experience, I have bought the bottom once, and I think I sold the top once. And it wasn't because of skill. Don't get me wrong, I have all my rules in place. I have a lot of strategies that we use at our office for our clients. And obviously that without a doubt, that stacks the deck in our favor. But picking the bottom, picking the top, I mean, it takes a little bit of luck. And there's nothing wrong with luck. Here we are. Like I said, I'm recording this on St. Patrick's Day. Nothing wrong with a little luck. But as one of my early mentors once said, the only people picking bottoms are monkeys. So we're not trying to be monkeys here. We're trying to buy high and sell higher, right? Buy low, sell high. It's kind of an enigma. What we want to do is we want to buy good investments as in terms of their ranking versus the market versus their peers, and we want to sell them higher once the firework is fizzled out. But anyway, if you don't fill out your bracket, you automatically lose. Those who sit on the sidelines waiting for the best time to invest, they only end up wishing someday down the road that they would have put their money to work earlier. They always do. Everybody always says they wish they would have put their money to work earlier. This is kind of a joke, but don't pick your brackets by picking your favorite mascots. And I know some people that do that, and maybe it works for them. I don't know. But when it comes to investing your life savings, when it comes to your retirement portfolio, picking your favorite companies. I live in. I'm making this up, by the way. This is totally fictitious. So I'm not literally saying this, but for instance, I live in Columbus, so I think I'll buy Worthington Industries. I live in Columbus, so I think I will own limited brands. I think I'll buy Scott's, Miracle Grow. I think I'll buy Big Lots. So in other words, buying companies that are close to you. If I live in Cincinnati, I'm going to buy Procter and Gamble. So buying companies that are just close to home, or I'm going to buy Kroger because I shop there. Not exactly the best, reason to invest your money. So same thing with March Madness, same thing with your retirement portfolio. You don't want to buy your darling stock, the place you shop, or your favorite companies based on personal preference. You want to buy what's strong. You want to buy what's exhibiting relative strength, or RS for short. And if you don't have a method, and this is the plug here, right? This is my shameless, biased plug. But if you don't have a method for filling out your metaphorical retirement portfolio life bracket, then find somebody who does have a plan. Find somebody who does have a strategy. Not everybody loves finance. In fact, I think most people don't. In fact, we always joke that's why we have a job here at our office, is because most people don't like this stuff. But not everybody loves finance. Not everybody likes financial planning, retirement planning, investment management, estate planning, tax planning, insurance planning, all the things that go into getting your financial house in order. Most people just don't like that stuff, and that's what we're here for. So if you have any questions, obviously we're always a soundboard to you. You never have to be a client to ask a question. Nobody at our office is ever going to push you to become a client. We have our own fit process as well. And what I mean by that is, we want to make impacts. We're talking multi-decade relationships and big impacts in people's lives. We're not looking for transactional relationships anyway. So if you have any questions, please reach out. If you have interest in getting a second opinion on your financial plan, please, without a doubt, reach out. Happy to do that at no cost. And obviously, if you don't have a financial plan, then please, by all means, reach out to us, because I think everybody needs a plan. It doesn't matter who you are, how old you are, how much money you have. I think a plan, well, as the saying goes, a dream without a plan is just a wish. So with that all being said, that's it for today's show. Please feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, please always remember you never, ever, ever have to be a client to ask a question. As I mentioned earlier, if you'd like to set up an introduction call to discuss your financial situation confidentially, or if you'd like to get a second opinion on your retirement plans, head over to our website. That's libertaswealth.com. Again, click on that little button in the bottom right-hand corner that says click here to get started, and somebody will reach out to you. Be sure to subscribe on iTunes, YouTube, Spotify, and remember, you can always sign up at libertaswealth.com, not only to get these updates, but you'll also get access to the screencasts, videos, and articles that we send our clients delivered as soon as they're released directly to your email inbox. Be sure to follow us on Facebook. We're at facebook.com/Libertas Wealth. I'm also on Twitter at Adam Koos, as well as Instagram at Adam, D as in David, Koos. And as I always say, there are thousands of podcasts out there, and you chose to give ours a listen today. Hopefully you had fun. I had a lot of fun today. So thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.